Okay, let's talk about the global cues then. Here's Mangalam with the world view.
Well, another day, another out on the Wall Street. So the Dow yesterday fell by about 550 points. We saw the sixth straight fall for S&P 500. The Nasdaq too dipped briefly and then recovered from correction territory. So that is something we will be keeping an eye out on. The Dow has lost 1,400 points in the last 2 days. However, the volatility has increased by about 100% in just the last 2 weeks, last 1 week rather. And Dow, while it closed about 550 points lower, it did recover about 200 points from the lows as well. The US 10-year yield has come in at 3.16, settled from a recent high of 3.26. The dollar index is benign at 95 as well, stabilized out there. Importantly, across the Atlantic, we saw a sharp rout in the European markets as well. All the frontline indices falling anywhere between 1.5% to 2%. And the emerging markets like Russia as well as Brazil saw some money being pulled out. Asia, however, starts on a mixed note. The Nikkei is mildly in the red, as is the Shanghai. The Hang Seng as well is up about 100 points. The Korean market outperforming out there, being led by the chipmaker SK Hynix, which has the maximum weight on that index. Oil prices have slipped to 80, which looks like it's good news for our markets because the SGX Nifty indicates an outperformance, indicates an opening to the tune of 40 points in the green.
All right. Thank you very much. I like that green take that you've ended the conversation with. Thank you very much, Mangalam. Now let's toss it over to experts to ask us, are we connected, and should this big rout in US markets continue to roil emerging markets? Quincy Crosby, Chief Market Strategist, Prudential Financial, joins us on the phone line. Quincy, well, I think you're joining us from New York, so good evening to you, and thank you very much for staying up for us. This two-day rout on Wall Street, in spite of it, over the last 24 hours, we seem to see some bit of stability in emerging market currencies. What's your sense? Does the rout continue in EMs, or are we at the end of the rout?
Well, yes, it's been quite a difficult number of days. For emerging markets, of course, the rout had begun some time ago as the U.S. dollar rose against the basket of currencies we trade against. And then you saw the U.S. dollar ease, and emerging markets got quite a strong bid. The question becomes, where does the U.S. dollar go? For example, if the Chinese currency begins to be devalued again, of course, that would push the U.S. dollar up, and I think that would add pressure to emerging markets again. But that said, I mean, how shall I say, we will be watching to see what happens with the U.S. dollar. In addition, we have to watch the U.S. economic data. That obviously has an effect on the U.S. dollar, and the inflation data. Clearly, with the CPI, the Consumer Price Index, coming in below consensus estimates, that helped to keep the dollar at bay. And so that also, I think, helped emerging markets.
Okay. Quincy, hi. Good morning from India. The MSCI Emerging Market Index is down about 15% this year, though. What are your thoughts on how the next 6 months may shape up? Do you see more selling pressure? And how are you approaching markets like India?
Well, as you know, emerging markets are not homogeneous, or rather homogeneous. I mean, each market is distinct, and for many investors, India has been an attractive market. But what happens is, when there is fear in markets, very often investors, traders, just sell and then ask questions later, affecting all of the markets. Okay. So that's the problem. And I think, though, that emerging markets, many investors, what we call retail investors, are very interested in getting back in. They are hoping that the U.S. dollar eases, and also they're hoping that China stabilizes in terms of Chinese data.
Yeah, actually, Quincy, at the moment, the yuan is a distance from the 6.94 it traded 48 hours ago. It's opened at 6.89 and trading between 6.89 and 6.9. Well, my short question to you is, do you think, at least for the near term, we have seen the highs for U.S. yields and the highs for the dollar index?
Well, this, again, is very important because it is predicated on where other currencies go, and that's been the difficulty for other markets. But that said, in terms of the U.S. Treasury yield, we saw that it's come down a bit. That also has helped the market. Again, much of it is based on the consumer price index really coming in below consensus estimates. But also, and this is important, perhaps investors now are coming into the U.S. Treasury market as a safe haven, something we did not see in the beginning of the rout. And that, of course, helps to push the yield down.
So your base case is risk-off continues?
I'm sorry?
Your base case is that risk-off globally continues?
Well, I'm looking at the futures market as well. And, we may open up in the U.S. very, very strong tomorrow. And also, tomorrow is the opening of the official of the earnings season. And we will get the blue chip of the financials. J.P. Morgan opens up before the, or reports before the open. That could help the market tremendously, give the market confidence if we hear positive news, positive guidance, and particularly if Jamie Dimon, the head of J.P. Morgan, offers an optimistic yet pragmatic view of where he thinks the economy is. If loan growth is strong, if loan growth is indicating optimism amongst their customers, that also could help. Okay. So all of these things are quite important.
Okay, Quincy, we all live in hope. Thank you so much for joining us and giving us your view. So looking forward to the earnings season in the U.S. markets, and perhaps she believes that the risk-off could come to an end anytime soon.